Hi friends, as part of technical indicator series, in this video we will be discussing about one of the most popular indicator and highly used by traders, and that is moving average. This indicator is very much popular because it helps us in identifying the right support and resistance levels on the chart. Also it helps us to identify the trend of a stock, and also the most important thing, it helps us in identifying the right entry and exit, and many more. So let us try to understand some of the important points regarding this moving average. So the first thing friends, let us try to analyze the name moving average. As the second word refers average, we are very well aware that in basic maths, average means it is just a sum of items by total number of items, right? And the first word moving. So why it is called moving? Let's try to understand in detail. Actually, it reassesses whenever new data points are found when we are applying this moving average indicator on the chart. Okay, so let me elaborate this in a more simpler way for you. So, friends, I have taken some data points here. Okay, so some price data points here you can see. Let's suppose uh, this is a week one, and each day. Okay, so this is day one closing price, and this is day two closing price on of asset, and day three closing price, and day 4 and day 5. All right, so let's suppose I want to use a 5-day moving average here. So how do we calculate? As we know the average, okay, so average is nothing but sum of items by total number of items. So as here you could see clearly, I have taken 5 days price points, and then I am trying to find out average of it, right? So which results 103. Okay, so it is just sum of all these data points by 5. So this is for the week which I am first 5 days which I am trying to calculate. Okay, now let's suppose we have got a week 2. Okay, there is again a new 2 price data points. Okay, so here since we are calculating 5-day moving average, as it has got 2 new data points, if we clearly notice here friends, it will consider the recent 5 days price data points, okay, and it has left the previous first 2 days, right? So this is what moving average, okay, it is constantly reassessing as and when the new data points were found. In a simple words friends, it considers the only recent price data points and then calculate, and this is how we can understand why it is named as a moving average. Okay, so I hope you understood. And the next point is, whenever this moving average indicator is used, it is directly plotted on the price of an asset on the chart. Okay, and the third important thing is friends, moving average indicator helps us in identifying the trend. So when the stock price moves above the moving average, then we can consider it as an uptrend, and at the same time moving average acts as a support when the price is trading above the moving average. And similarly, when the stock price is moving or below the moving average, so we can consider that the stock is trading in downtrend, and again the moving average acts as a resistance when the stock is below the moving average. Okay, and one more important thing is there are different types of moving averages that we have: simple moving average, exponential moving average, and weighted moving average, and many more. Okay, so we'll try to understand two types of moving averages, and that is SMA and EMA, like simple moving average and exponential moving average. So friends, here you could see clearly, we have taken simple moving average and the other side exponential moving average. Okay, so let us try to understand the definition of a simple moving average. So it is an indicator which gives equal weightage to recent and old price data. So there is no priority or there is no high weightage given to recent price data. It just gives equal amount of weightage to all the price data points that we are going to take. Okay, so let's suppose I'm going to take a 10-day moving average, like 10-day simple moving average. And if you see the formula of simple moving average, it is quite simple as the normal average formula. Okay, sum of items by total number of items. Okay, so here you could see uh, a1 plus a2 plus and so on till an, where a1 talks about the close price of day a1 and a2 is close price of again this a2 day, so and so on and so forth, and divide by total number of days that we are calculating for. So this is how a simple moving average works out. Now let's try to understand exponential moving average. So let's try to look at the definition first. It is an indicator where it gives more weightage to the recent price data, guys, and less weightage to the old price data. So this is very clear, friends, that this indicator gives more weightage to the recent price data and less weightage to the old price data. Okay, if you see the formula, it is a bit complex to calculate, but here we are not here to do a PhD on the formula and how it works out. But let's try to understand the definition and how it is calculated. Okay, so what happened, friends, in simple moving average? It is just a calculation of average where it gives equal weightage to old price data and recent price data. And whereas here in exponential moving average, it gives more weightage to the recent price data and less weightage to old price data. Okay. So friends, if we closely analyze the differences between this simple moving average and exponential moving average, in simple moving average, as it gives equal importance to all the price data, this indicator might not be as much as reactive as exponential moving average. Correct? Because it gives more weightage to the recent price data, so it is more reactive to the price movement of a stock, right? So now I hope you got a better idea that exponential moving average reacts way better than a simple moving average to the price movement of a stock. Okay, so now let us try to understand how it looks when we apply it on the chart, so that you will get a clear difference between a simple moving average and exponential moving average. Okay, all right, friends. So we have taken here ICICI Bank, and I have applied 1 day time frame. So this is how the chart looks like. Now let's try to use the moving average indicator here on the chart. Okay. So now let's try to apply indicators on the chart. So when we click on studies, let's type for a moving average. I'm apply. Let's suppose we want to apply for 200 day, and the field is close, and type refers to what type of moving average that we want to choose. Okay, so here let's try to first look into simple moving average. Okay, so I've selected simple, and the color which I have chosen is red, and click on done. So this is how a 200 SMA indicator appears on the chart. Okay, so here you could clearly notice that the indicator is very far from the actual price movement, right? There is a some gap, there is a huge gap, right? Now let's try to apply a 200 EMA, and let's see the clear differences. So I'm applying exponential here. I've taken the type exponential. So let us choose some other color. So I've taken a black here and click on done. All right. So friends, here you could clearly see that since the stock has fallen here, the red color one is 200 SMA and the black color one is 200 EMA. Okay. So here, when the stock has fallen, the SMA is less reactive to the price movement, correct? Whereas if you could see clearly, the 200-day EMA is more reactive than SMA, right? If you notice here, the EMA is a bit closer to the actual price movement of the stock, correct? As the EMA indicator gives a more priority to the recent price data, this actually makes it to move closer to the actual price movement of a stock. So I hope you understood the difference between SMA and EMA. Okay. So now let me remove the one indicator for just to avoid confusion. So friends, here you could clearly see that, as we have discussed at the start, that moving average indicator helps us to identify the trend and also it acts as a support and resistance level, right? So here you could see the stock has broken this level and it has uh, moved upside, okay? And then later what happened, friends? As long as the stock is trading above the moving average, this indicator 200-day moving average indicator, you could clearly notice that whenever the stock again comes back to the near 200-day EMA, it is considering this as a strong support, and it is clearly you can see that there is a price action at this level, and again it continued to go upside, okay? And again there are a couple of times it has reacted exactly at the moving average indicator at 200 EMA, okay? Since it has crossed the 200 EMA, you have gone for a long. And where is your stop loss, friends? So as and when it breaks the 200 EMA, so that is your stop loss, that is your exit. So this is how you can plan. So let's suppose here you have taken position after the breakout, and later there is no breakout to downside, so only at this level you have found a breakout. So this is where you can plan your exit. So this is how one can trade using a moving average indicator and can interpret the trend of a stock, and also you can use it as a support and resistance, and as well as the most important thing is to find the right entry and the right exit, okay? So I hope you understood about this SMA and EMA and its difference, okay? So there is one more important thing, friends, that you need to understand, and that is a moving average crossover, okay? So let's suppose if you are using this indicator and to filter out for your investment or for your trading, okay, depends on the period that you are planning to invest or trade. Let's suppose you are planning for a long term investment, okay? In that case you can use 50-day moving average and 200-day moving average. And if you are planning for a mid-term or trade or investment, like couple of months or 6 months or 1 year, less than 1 year, you can use 20 EMA and a 50-day EMA. If it is a short term, like if it is for a weeks or number of couple of days, so you can go with 5-day moving average and 20-day moving average. So it not necessarily be a exponential moving average, it could be also a simple moving average, but try to use both of them same, either it could be a simple moving average or exponential moving average. Now let's try to use them on the chart and how one can take position based on this moving average crossover, okay? Okay, so we are back again on the ICICI chart. Now let's suppose here already there is a 200-day EMA. Now let's suppose I want to take a 50-day EMA, okay? Let's click on done. So here you could clearly see that as and when the 50-day moving average crosses 200-day moving average, let's suppose this place where there is a crossover, so you can go for a long, and again wherever it again crosses, whenever the red line crosses the black line again towards the downside, so this is where you can exit from the stock or you can go for a short position. So this is how the crossover works. So moving crossover is one of the most famous indicator strategy that many traders and investors use in their trading system. All right. So if someone is planning for a midterm investment or less than a year, so one can use a 50-day EMA with 20-day EMA. Okay. So I'm showing you exponential moving average because it is more reactive to the actual price movement. Okay. Click on done. So here you could clearly notice, friends, whenever again the 20-day EMA crosses 50-day EMA, you can go for long, and whenever the 50-day EMA crosses the 20-day EMA, either you can consider it as an exit for a long position or you can short it. So that is how a crossover works, and this is how you can plan your trade, friends, using the crossover system. So similarly, it is not a standard or any fixed indicator that one should use. It's all up to them. You can use 50, 100 or 50, 150. Okay, depends on your analysis. You can prefer the right combination and you can plot it on the chart and just get the signals and go with that. Okay, so always try to use more than one indicator in your trading system. Don't just rely on the one indicator, be it a moving average or anything. So at least go for a crossover. It helps you to avoid the false signals, and without losing much of your hard-earned money, you can even exit with a less loss. So I hope you understood about the moving average and the importance of exponential moving average and simple moving average and its difference. Okay, so don't go for a trade blindly. At least try to use these indicators so that your decision will have a better probability of success. Okay, thank you, friends.